Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth-building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 19 of the Financial Flow. I'm Philip, and today we're diving into a question that gets to the heart of retirement planning. What's a retirement withdrawal rate, and why is it important? Before we get started, please remember to share, like, and subscribe if you find this episode helpful in your pursuit of retirement success. A quick reminder, my transcript serves as my show notes. If you can access my transcript, then you'll find my linked sources at the very end of the transcript. When you reach retirement, managing your nest egg becomes just as important as building it. Deciding how much to withdraw every year is tricky. Take too much and you might run out of money. Take too little and you could be missing out on enjoying your retirement to the fullest. Today, we're going to talk about different strategies for determining your withdrawal rate. We'll cover the tried and true 4% rule, the more flexible Guardrails approach, and the retirement smile distribution method. Quick disclaimer, regardless of what you hear or read online, there's no one size fits all, and no solution is a perfect fit for every financial situation. So what is a retirement withdrawal rate? Simply put, your withdrawal rate is the percentage of your total savings that you take out each year in retirement to fund your lifestyle. Let's say you've saved $1 million for retirement. If you withdraw $40,000 annually, you're using a 4% withdrawal rate. Now, the real question is, how do you make sure you don't outlive your money? This is where choosing the right withdrawal strategy becomes crucial. You've likely heard of the 4% rule. It's a classic, the old faithful of retirement planning. But is it enough? The premise of this guideline is that if you withdraw 4% of your retirement savings each year, adjusted for inflation, you should be able to sustain yourself for a 30-year retirement. The rule is based on historical market data and assumes a well-diversified portfolio of stocks and bonds. Now, diversification is not a guarantee against loss, and it also isn't a guarantee that your money will last any period of time. Is the 4% rule still relevant today? Like every classic, there's some debate over whether it should truly be the standard bearer. Sure, it's a great starting point, but it doesn't take into account things like longer life expectancies, unexpected health costs, or market downturns. And if you're self-employed, your retirement savings may not be as conventional as someone with a pension or fixed retirement income. You might need to be more flexible. This is where the guardrail strategy comes into play. Think of it as driving down a winding mountain road. You've got guardrails on either side to prevent you from veering too far off track. In terms of your withdrawal rate, this method allows you to adjust your spending as needed, but within limits. For example, if your portfolio performs well, you can increase your withdrawals. If it takes a hit, you tighten the belt a bit to keep from depleting your funds. Your income works within a range of withdrawal limits, not so high that you hasten the drawdown of your portfolio, and not so low that if the market declines, you'll be impoverished by the reduction in income. What makes this method appealing is its adaptability and the potential for a higher withdrawal rate. It gives you the ability to spend more when things are going well, but protects you when the markets are down. Because of the built-in assumption of reduced spending when markets decline, you may be able to safely sustain a higher average withdrawal rate than the standard 4% rule. For solopreneurs who are used to the ebb and flow of business revenue, this strategy could feel like second nature. Now, let's talk about the retirement smile, the go-go, slow-go, and no-go years. The retirement smile method is based on the idea that spending in retirement doesn't stay constant. You might spend more in the early years when you're active and crossing things off your bucket list, travel, new hobbies, home renovations. As you age, those expenses tend to decrease. Now, the bucket list has a lot of check marks, but at some point that desire to go has abated. By the time you're in your later years, healthcare costs for you may be rising, bringing spending back up. So picture a smile. Higher spending at the beginning, a dip in the middle, and then an uptick toward the end. The beauty of this method is that it mirrors real-life spending patterns, which can help you avoid the rigidity of the 4% rule. Now, each of these approaches has its strengths and weaknesses. The 4% rule is simple, easy to follow, but rigid. It doesn't allow for much flexibility if your expenses change. On the other hand, the Guardrails method offers that flexibility, but for some, may be stressful, especially if you aren't working with a financial planner, as it requires consistent monitoring of your portfolio's performance. Finally, the Retirement Smile gives you a more realistic picture of how your spending will likely change over time, but it requires more planning up front to ensure that you have enough for the later years. It's a great option if you want to enjoy your retirement early, but don't want to worry about running out of funds later. If you're a solopreneur, your income has likely been unpredictable or had periods of unpredictability throughout your working life. You might not have the safety net of a traditional pension or consistent salary, so planning your withdrawals with care is even more critical. Solopreneurs often have multiple income sources, like rental properties or part-time consulting, which can complicate how you determine your future withdrawal rate. Keep in mind, as mentioned in episode 18, the starting point for determining your need is knowing how much you spend. Flexibility is key here. You might want to blend different strategies, like starting with the 4% rule and adjusting with the Guardrails when necessary. One common mistake retirees make is underestimating how long they'll live or how much healthcare will cost in the later stages of retirement. Another risk is market volatility. If you're withdrawing during a market downturn, you may need to pull out a larger percentage of your portfolio to cover expenses. This is called sequence of returns risk, and it's something every retiree should be aware of. Finally, there's the risk of inflation eating away at your purchasing power. All of these factors highlight why it's so important to not rely on one strategy alone, but instead adapt and adjust as you go. This also explains why having a financial advisor who can help you navigate these complex decisions adds so much value. So what's the takeaway here? A one-size-fits-all withdrawal strategy simply doesn't exist. The 4% rule is a good starting point, but methods like the Guardrail strategy and the Retirement Smile allow for more flexibility and customization. Ultimately, the best approach is the one that reflects your unique financial situation, your goals, and your tolerance for risk. Or, as is commonly said about dieting and exercise, the best method is the one you actually use. So let's take some action on this. This week, I encourage you to review your own retirement withdrawal strategy and see if it's time for an update. In the next episode, we'll take a brief look at the primary income strategy I use with clients, the Guardrails approach to retirement income. Stay tuned. Thanks for tuning into this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.